Good day, Iggy. For today's interview series, I'd really like to dive into analyzing SGX dividend stocks like a professional investor with you. With all the changes happening in Singapore's retirement landscape and the attractive yields we're seeing, it's a topic I know many are curious about.
Hey, Ivana. Good morning. Absolutely. I'm excited to discuss this crucial topic. As you know, I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth here at the Investing Iguana. Our channel is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 900 videos with more than 450,000 watch hours as of June 2025. This dividend analysis topic is particularly timely given the major CPF changes we're seeing in 2025.
Speaking of those CPF changes, can you walk us through how they're affecting dividend investing strategies for Singaporeans?
Great question, Ivana. The CPF overhaul is significant. For those turning 55 in 2025, the basic retirement sum is SGD 106,500 and the full retirement sum is SGD 213,000. The enhanced retirement sum has been raised to 4 times the BRS, making it SGD 426,000. The monthly salary ceiling has also increased to SGD 7,400 from SGD 6,800. Additionally, the CPF special account is being closed for those aged 55 and above from January 19th, 2025. These changes mean people need to think more strategically about dividend income to supplement their retirement needs. This kind of granular detail is something we often break down in our daily premium content, where we get a head start on these insights.
That's quite substantial. What's happening with Singapore's major dividend-paying stocks right now?
The big 3 banks are performing well, but let me give you the accurate current picture. DBS currently offers a dividend yield of around 5.33% as of June 2025. OCBC has announced the SGD 2.5 billion capital return program with special dividends, though their current dividend yield is around 3.72%. UOB unveiled an even bigger SGD 3 billion capital return package, including special dividends of 50 cents per share over 2 tranches in 2025, with their current yield at about 5.09%. These represent real money flowing back to shareholders, though yields vary significantly between the banks.
Those yields sound attractive, but how do we separate the genuinely good dividend stocks from the potentially risky ones?
This is where professional analysis becomes crucial, Ivana. Never chase the highest yield blindly. I use time-tested criteria. Look for companies with strong fundamentals, current ratios greater than 1, and manageable debt levels. Think of it like buying a car. You don't just look at the price tag, you check the engine, maintenance history, and reliability. For dividends, focus on companies with positive trending earnings and payout ratios that don't consistently exceed 70 to 80% unless they have exceptional cash flow stability. Tools like SGX's free stock screener or Stocks Cafe can help filter based on these fundamental criteria.
Can you give us a practical example of how to evaluate a specific stock?
Absolutely. Let's take DBS as an example. They're currently yielding around 5.33%, which is attractive, but not excessively high. You want to examine their payout sustainability, earnings trends, and balance sheet strength. Compare this to a company with a 90% payout ratio and declining earnings. That's a red flag. The key is finding that sweet spot between attractive yield and sustainable fundamentals. I shared a similar analysis with our members a few days ago, giving them a real-time perspective on this development.
What about REITs? They seem to offer higher yields than traditional stocks.
REITs are particularly interesting right now. Singapore REITs are transitioning toward more sustainable distribution models. According to recent analysis, fiscal year 2025 forecasted yields for S-REITs are expected to settle around 5.5% when adjusted for capital top-ups and full cash-based management fees, down from reported levels of 6.1%. Many REIT managers are shifting from paying management fees in units to cash-based fees to reduce dilution. For example, Keppel DC REIT, which just joined the STI in June 2025, offers a 4.4% dividend yield. It's like choosing between a flashy sports car that breaks down frequently versus a reliable sedan that gets you to work every day.
How should someone structure their dividend portfolio for retirement income?
For a SGD 500,000 retirement portfolio, I recommend this allocation: 40-50% in established Singapore blue chips like the major banks, 20-30% in quality Singapore REITs, 10 to 20% in Singapore savings bonds using laddering strategies, and 10% in money market funds for emergency access. This targets annual dividend income of SGD 20,000, 25,000, which is that 4 to 5% yield range. Given the current CPF retirement sums, BRS of SGD 106,500 and FRS of SGD 213,000 for those turning 55 in 25, dividend income becomes crucial for closing retirement income gaps.
What are the biggest mistakes you see investors making with dividend stocks?
The biggest mistake is treating high yield as automatically good. Many investors fall into this trap, focusing on headline yields without understanding cash flow generation. Another major error is not understanding the new CPF changes. With special accounts closing for those 55 and above, people need to plan their dividend strategies more carefully. It's like eating your seed corn. You might satisfy immediate hunger, but you'll have nothing to plant next season.
How does Singapore compare to other regional markets for dividend investing?
Singapore has significant advantages. Malaysia now imposes a 2% tax on dividend income exceeding 100,000 ringgit annually, effective January 2025. Thailand has complex dividend tax structures with various exemptions, and Indonesia applies 20% withholding tax for foreign investors. Singapore's one-tier tax system provides tax-exempt dividends for shareholders. We're essentially the regional dividend hub with superior tax treatment and regulatory transparency.
What's your process for monitoring and rebalancing a dividend portfolio?
I establish quarterly review processes to assess dividend sustainability, payout ratio changes, and business fundamentals. Singapore's transparent reporting requirements make this easier than many markets. You need to coordinate dividend investment timing with the new CPF optimization strategies, especially with special accounts closing for members aged 55 and above. Use tools like SGX's Stock Screener or platforms like Stocks Cafe to filter stocks based on fundamental criteria. Think of it like regular health checkups. Prevention is better than cure.
Any specific screening tools you'd recommend for beginners?
Start with SGX's free stock screener, which collaborates with Refinitiv and offers comprehensive filtering capabilities. You can also use Stocks Cafe for Singapore-focused analysis. Set minimum thresholds: dividend yield above 2.5%, current ratio above 1, and debt to equity below reasonable levels. These tools help you avoid emotional decisions that often lead to poor outcomes. It's like having a GPS for your investment journey. It keeps you on the right path, even when the market gets confusing.
What's your ultimate take on dividend investing for Singapore retirees right now?
This is actually a solid time for dividend investing in Singapore, though investors need to be realistic about yields. With S-REITs settling around 5.5% yields, bank stocks like DBS at 5.33% and UOB at 5.09%, there are decent opportunities. Singapore's economy is maintaining steady growth, and our position as the fourth-ranked global financial center strengthens the investment environment. But success requires focusing on quality companies with proven dividend sustainability rather than chasing yield alone. The key is building sustainable portfolios that work with the new CPF framework, BRS of SGD 106,500 and FRS of SGD 213,000 for 2025, while preserving capital for long-term financial security.
Iggy, that was incredibly insightful. Thank you so much for breaking down SGX dividend stock analysis with the most current data for us today. I certainly learned a lot about the practical steps and updated considerations involved.
My pleasure, Ivana. It's always great to discuss these crucial topics with the most accurate, up-to-date information that directly impacts people's financial futures. For those who want to really stay ahead and get my daily insights, sometimes even before they're generally available, that's what our premium members enjoy for just about the cost of a coffee each month. It's truly a valuable resource for consistent, actionable information.
Absolutely. Thank you, Iggy, for providing your insightful analysis with the latest data. I look forward to our next video podcast together.